Okay, good morning everybody. Just past 8:30, Monday, the 11th of January. I hope you're all well and I hope you survived. Um, what a volatile week we had last week. All of the historical stats, of course, are coming out. I'm sure you've read them in the Financial Times this morning. The fact that this was the worst week on record for many markets. It was the worst first week of the year ever for the S&P, down just over 5%. Overall, the Chinese indices down 10% for the comp, the Shanghai, Shenzhen down nearly 15%. So a real week of financial market turbulence. And let's just have a quick recap of what exactly happened. Why was this the worst week? Why were so many records hit? Well, I think it's been shown by what the Chinese have been doing on the offshore renminbi rate over the weekend and overnight last night, buying up renminbi, trying to stop the fallout of the Chinese currency. Really what we're seeing here is extreme volatility levels in the Chinese currency as they're trying to reach a benchmark of non-intervention in financial markets. So what the Chinese are trying to do is reach a point where the financial markets are able to move and operate as they are in other developed economies without the special teams intervention, without the PBOC's intervention, without the government's intervention. However, to say that they've made a hash of this move from interventionist to free market approach is a masterpiece of understatement. It's been a bit of a disaster. Having circuit breakers on the main indices at 5%, as you saw last week, that then get hit, stopped for 15 minutes, and then straight away hitting 7%, was it 10 minutes after that? They've made a real hash of it. So why, therefore, have we seen a bounce in equity prices this morning? This is what I want you guys to try and understand. You see, here my trades on the DAX this morning. I've been long the DAX a couple of times. I was looking to the push higher. It's been a good morning, but I didn't take advantage of the main move. I've also been trying to long Euro stocks for a break above the pivot level. Look at this chart on the top left. Exactly how the Euro stocks came up to that pivot level. Test, break higher. The S&P pushing higher as well. Oil finding a bit of strength also, as you can see on the bottom right-hand side of my chart. Let's have a look at the S&P. S&P moving towards its pivot level, moving towards Thursday's lows. Why is there a risk on this morning? Well, the Chinese indices actually had a difficult day yesterday. And they had a difficult day perhaps for a number of ways. It depends how you look at it. They had a difficult day as the Premier came forward and said they would not add to market stimulus. They would do less to prop the financial markets up. They would review their interventionist policies and try and step away from really getting involved in the Chinese volatility. And although this might be a negative thing in the very short term, actually, I think it's a good thing. If you think about the markets last week, sold off, had these record down weeks because of China making a hash of how it intervened in financial market activity. So straight away this morning, we have the news that China are going to try and do more to step away. In fact, they're saying we're going to do more to allow the market to fall, which counterintuitively is actually a good thing for the value of the market. Does that make sense? So last week, the market moves lower, well, because of currency volatility, well, because of the PBOC, the government, and the national team making a hash of their policy. And so overnight, we've had Premier talk about how he's going to step away from such interventionist policy. And so far this morning, we've seen great risk on moves. Right from the market open, you could see the buying power, certainly in the DAX. A couple of our traders were trying to get long Euro stocks on the pivot level break here, but difficult with the timing on this, just going from 34 down to 30 before eventually popping. If you did manage to hold that long, then well done. Okay, major news then also, guys, on the Euro USD, on the ladder, there's been a change. So let me bring up my live ladder here. I'll just bring the window out of page. I'll put on one contract just so I can show you. Now, you remember the Euro USD used to always be $12.5, 12.5, let's see if I can just get a short on there, $12.5 per one price. But now look at my P&L here. have a look at my P&L. Instead of moving in $12.5, it's moving in 6.25. 6.25 instead of 12.5. So 12.5 is two prices offside now rather than one. Okay, I had lost one price, so this is showing one tick offside on this ladder. If we go back down now and start trading at sort of the 60 level, then I'll be able to take this off, and I would have made 6.25 times 2, so I would have made 12.5. Now, for all better take that off. That's the beauty of this being such a short, small tick size. For all Amplify traders, this is good news, really, in terms of doubling the contract size that you're going to have. If you had just been moved onto the live market and you were trading with only one contract, then you now have two contracts. The same risk limits would apply, obviously, but it's very good news in terms of being able to have more, if you like, contracts at your disposal to engage in the market, to sort of scale in, to scale out of positions. It does help, and we always talk about having more contract size helping in your execution on the ladder. So what are your plans for this week then, guys? Well, certainly it's been a slightly more risk-on tone so far. Otherwise, we've got a quiet day today, really, data-wise. Well, before I move on to this week, sorry, last week was such a massive week in financial markets, I haven't even got round to mentioning non-farm payrolls. 292 versus the 200,000 expected. Much better expected data on the headline, but isn't it interesting? We do a lot of work here talking about market behavior and sentiment, trading psychology. If you were to have traded that data long, which I did in the S&P, right on that data getting released at 130, we were all looking at 1960 here, weren't we, in the S&P? Do you remember, as the data came out, here's the S&P, we're all looking at 1960, a number of people got long, looking for a break above that key level. You had to be pretty quick to start to take profit out of the S&P, because very quickly after that data, we got back below 1960, and it was the getting back below 1960, perhaps using that as the classic that was the trade, as really, despite the fact this data was good, it wasn't enough to deter people from worrying about the fact we're coming into the weekend and China is having one of its worst weeks on record, and the risk-off tone continued. And in fact, look at how the S&P then traded after that. This is what's so difficult about non-farm payrolls and why you have to take into account the behavior of the market. What is the market really worried about? What were we really focused on at the end of Friday? Well, it wasn't the fact that it was a stronger non-farm payrolls than expected. It was everything else that had created the worst week in history in many assets, and not being connected to us, not having that bird's eye view of what the market's looking at here. If you were holding on 10 contracts long on the S&P after that non-farm payrolls, you're down $25,000. Can be frustrating for traders looking at how these equity indices are reacting, saying, what are they looking at? Can they not see this data was expected? But this is where you're better than expected. This is where your discipline comes in, guys. If you're wrong, just get out. Just get out. Direct, yeah, obviously there was a lot else in there. It wasn't just the earnings, actually. It was also, you could say that the wage growth was slightly lower than expected. There are other factors, of course, but what I'm trying to say is those that were focused on the headline figure could well have made a mistake by holding on to that long view and not taking into account everything else that the market was looking at. But discipline, as always, will save your account much more than trying to be a hero and say that the market is wrong. It's never wrong. So non-farm payrolls, well, what does it mean? It means that the likelihood of an interest rate right in March has gone from 41% probability all the way down to 40% probability. So that hasn't really changed the outlook, if you like, for the Fed liftoff. 41. So from 41% down to 40%, very minimal reaction indeed. And keynotes Well, T-notes were an interesting one to trade. Did anyone here trade T-notes on non-farm payrolls? Because you, of course, got the initial move after the data on Friday, the initial push lower. But actually, after that, this is what I find fascinating. You know, if you were just to see the headline of that non-farm payrolls data, you would not have thought T-notes would have rallied so aggressively higher. But not only were the data drill down and the earnings, but also here was the lack of inflation that really supported T-notes. So non-farm payrolls was an okay one to trade if you were quick, if you were fast, if you took profit whilst it was there, and if you didn't try and force positions. But otherwise, I think anything after 15 minutes after the data, things got pretty tricky indeed. Looking forward to this week then, guys. Let's hope, certainly I hope it's as volatile week as the week prior. I doubt it will be, just looking at this market's recovery already. But what have we got? Light morning this morning, more UK data coming out later on Tuesday, and that's going to be interesting given what's happened to cable last week. The pound taking an absolute shoeing. If you have a look at the euro versus the pound, so the code for that on your charts, guys, is EB, the euro versus the pound. Look at how the euro pound has performed over the last 2 months, sorry. 70 all the way to 75.5. That's a huge move in the euro pound. And interestingly, if we now go to a weekly chart, there's the sort of technical break above the majority of the 2015 highs. And this must be hard on the macro front. Looking at this euro versus the pound, again, I would say that here, I would be wrong-footed on my macro view. If you were to ask me midway through January what's going to happen to the value of the euro versus the value of the pound based on monetary policy differentiation, i.e. the fact that the Bank of England should be the first central bank to raise rates after the US, and the fact that the ECB are going to continue to ease, I'm not in a long-term position on this euro versus the pound, but I definitely would have got this one wrong, trying to predict the future on this currency cross, that's for sure. Coming out this week, we've got US very light data really. Wednesday, Chinese data, import data out of China. Just a note on Chinese data, the PPI, by the way, manufacturing PPI, that was the 48th negative month reading in a row over the weekend. That also added to the Chinese fallout. Perhaps that's another reason why markets fell off going into Friday. December monthly statement out of the US on Wednesday and Thursday. German GDP data will be interesting, along with the Bank of England rate decision and latest ECB minutes. So Thursday is probably going to be the main day of this week, I would say, certainly on the monetary policy front. We do have a data-heavy Friday, though, as well. US December retail sales, PPI, Empire State Manufacturing. So most of the action, guys, is going to come Thursday and Friday data-wise, but we do have speakers coming in Tuesday and Wednesday. So don't expect trading conditions similar to last week. It might be lighter. Look at this continued move now in European equities. I took that in hindsight, obviously, perhaps getting out of that second profitable DAX way too early. These equity markets are really starting off the week on the front foot. Bund lower, euro dollar lower. That's also going to be supporting equities. Relatively quiet on the data front, but certainly we've already had almost a whole day's worth of volatility already. Guys, good to see you again. I hope you survived the first week of the year. 2016 is definitely off to a positive start if you're an intraday trader. I hope you're taking advantage of it. I look forward to working with you in the room. Have a good day.